In this section of the chapter, we're going to discuss different types of bonds, you will, or what kinds of companies issue debt, if you will, looking at market segments. So as we go through here, we're going to talk about, again, different kinds of things that you can buy. So the first thing you can think of, or a good place to start with the discussion, are Treasury Bonds. Obviously issued by the United States government. They are considered to be the highest quality. In fact, we frequently refer to them as being risk-free debt because they are backed by the full faith and credit of the United States government. Treasury bonds typically have a maturity of 30 years, while Treasury notes are typically 2, 3, 5, 7, and 10 years. So interest is paid semi-annually. One of the features of this debt is that with government debt in general is that you pay taxes to the entity that issued it. So in this case, since the federal government is issuing this security, you're going to have to pay federal taxes on this income. However, it is exempt from state and local taxes. In a minute, when we talk about municipal debt, we'll find out that you don't pay federal taxes, but you will have to pay potentially state and local taxes. Today, typically, all Treasury securities are non-callable securities. They're issued at regularly scheduled auctions. As you know, the government goes on whether or not the market changes or not. We still owe money. We still do things, provide benefits, securities, and security and things for our citizens. So we're in constant need of raising funds and replacing old debt. One of the types of government debt, Treasury debt, is something called a TIP. Now, a TIP is a bond that adjusts itself for inflation. One of the things that we talked about with respect to risk is that there is purchasing power risk, especially for a bond that has 30 years of life. Inflation is going to have an impact on the ultimate value, the purchasing power of that money received later on. So what a treasury bond, what a TIP does is it adjusts for inflation. And we'll talk about this, how it works a little bit later when we look at the impact of changes and actually these TIPs and their returns. Another type of debt that we talked about is agency debt. This is government debt, United States government debt. However, even though they're high quality, that means they're low risk, they are not backed by the full faith and credit of the United States government. Now, the government would most likely not let these agencies default on their debt, but these are government agencies that need funding to do their job for the government, so they issue debt for that. Since they're slightly higher risk than United States Treasuries, of course, they will have slightly higher returns and yields than United States Treasuries. Municipal bonds are issued by states, governments, school districts, etc. There are essentially two types of these. A general obligation bond is issued to run the government agency, to run the county, or to run the city. So these are things that are used just as a general fund, if you will, to get money in order to maintain and administer the duties of the government itself. However, from time to time, the government will do projects that could earn money. Toll roads, for instance. So to raise money to maintain and or to build toll roads, the government would issue something called a revenue bond. the tolls that we pay help to pay off the revenues, the actual bond debt on these issues. Some of these entities will have bond guarantees, which is a form of insurance. So this level of insurance will increase the quality of the bond. So they'll have higher ratings. That means they'll have less risk, which means typically lower risk will mean they'll have higher prices, and they also could find themselves in a position of being able to be more liquid, if you will, so that it's easier for people to buy and sell them because of this insurance. Now, one of the things we want to talk about with respect to municipal bonds and federal bonds, quite frankly, Treasury bonds, is the fact of this interest, tax-exempt interest basis, if you will. So if you were thinking of buying a bond, let's say you wanted to buy a corporate bond that was paying 8%. Now, on 8%, of course, since it's a corporate bond, you'll have to pay taxes. You'd have to pay federal taxes. You might also have to pay state and local taxes. But what if you were considering an equally risky municipal bond? Now, a municipal bond is exempt from federal taxes. So if one was 8%, the corporate bond, and the municipal bond was 6%, which would you rather invest in? Well, what we want to determine is the after-tax yield that you receive. They refer to this as the taxable equivalent yield, but really we're looking at after tax. How much do you get to keep after you pay all the taxes that are out there? So if we want to bring a municipal bond and look at it, well, what would it be if it was taxable? So we can compare a taxable corporate to the, in quotes, taxable municipal bond. We would want to create this thing called the taxable equivalent yield. In this case, you take the yield of the municipal and you divide it by 1 minus, and there's the formula for the federal tax rate and the state tax rate. And again, we would adjust that, just the state tax rate for the federal taxes that we would be able to write that off against. But again, this is just a formula that gives us an idea of what this bond would actually be worth. So let's say here, bond A is a corporate bond of 8%. Bond B is a state bond from a state that you live in and has a 5% yield. And you're in a 25% tax bracket. What is the tax equivalent yield? Well, after taxes, right, the tax equivalent yield, apply this formula, is 7.017%. So which would you rather have after taxes? Would you rather have 8% or would you rather have 7%? Or which would you rather have, the corporate bond at 8% or the B bond, which is 7%? And obviously in this case, you'd rather have the 8% because after taxes, it has a higher return than the municipal bond. So here we can look here, if this is your tax bracket, here's the tax-free yield. And you can see that as your taxes go up, you require higher and higher returns for these things to be equal, in other words. So a government bond, a 7% federal bond, municipal bond, you would have to have a corporate bond of 10.45% or better to have a better return than this 7%. So again, this is just a way of applying and looking at our debt to understand after taxes which one is better. So if you look at some major market segments, again, we can switch from the government and start talking about corporations. All kinds of corporations issue bonds. There's all kinds of quality. There's all kinds of types of bonds. The reason people buy bonds typically is because they have steady, predictable income. That's why people typically invest in debt. That's why senior citizens have rather large components of their debt is recognized or is comprised of bonds because they need the cash flows. There are some specialty issues. There are things referred to as being zero coupon bonds. They don't pay interest. They're sold at what's sometimes referred to as a deep discount, right? They're very far below their par value. Now, essentially what happens with these is that because there's no interest rate in particular, there's a tremendous amount of price volatility as interest rates in the economy change. So what we may have to do is there are some special situations where zero coupons may make sense. I can't think of why an individual would want to invest in zero coupon bonds, but there could be some corporate ventures or corporate reasons why you might want to invest in them. Again, these bonds are different. They pay no interest. The government really doesn't like that. So essentially, these actually have a special kind of a tax consequence that in the end, they may have a need, if you will, to pay taxes as you go. There are mortgage-backed securities. This is debt that has been created to assist the banking industry in providing money for people to buy houses. There are three primary agencies: Ginnie Mae, Fannie Mae, and what's referred to as Freddie Mac. These are what they refer to as a self-liquidating investment. That is, when you purchase a Ginnie Mae bond, for instance, you're going to receive a payment, typically monthly. And that payment is going to look like what a car payment looks like to the bank. Part of it is interest and part of it is principal. So the income that you receive from these is both the interest, obviously from the debt itself, the coupon, but you're also receiving a repayment of your investment as time goes. So there are different kinds of bonds. They're there to help the banking industry. There are things called collateralized mortgage obligations. Quite frankly, these things are not, I don't want to say they're very new, but they are new relative to how they're used in the marketplace. These instruments, in my opinion, is what has created the most recent crash in the mortgage industry. Not so much because of the interest, but because of how bankers were using them. And essentially what they did is they gathered mortgages of a variety of qualities, from very, very safe mortgages to very, very risky mortgages. And they combined them all into this package. And then they took the package and they divided it into different component parts. They refer to them as tranches. Essentially, they're different securities for different kinds of investors. Some people want short term, some people want long term. So essentially what happens is there is a payout that goes to these investors based on the class that they choose. They are very complex. They're fairly risky. They actually, in my opinion, were the creation of most of the issues in the mortgage crisis. But essentially, the question remains is what happens if a person pays off their mortgage ahead of time? Right? This is what they refer to as prepayment risk. So these things have some even additional risk. Now the challenge that I have with these types of securities is that in the end, what has happened is banks have used this type of debt to reduce some risk, but because everything has been put into one big pile, when the mortgage industry started to fall and people started to default on their debt, the entire collateralized mortgage obligation market collapsed because they had put all of this old bad stuff, these risky bonds, they combined them with all these better mortgages, if you will. So now we basically have created gravy, if you will. And once you create gravy, you cannot uncreate gravy. So we're in a position where in the end, we are now stuck with these obligations that part of them is bad, part of it has defaulted, and we can't figure out what parts are. Again, that's a little bit of my opinion, but I think that's essentially what happened in the banking industry and the mortgage industry. There are all kinds of these asset-backed securities. You can find them on student loans. You can find them on credit cards. But there basically is a mechanism, if you will, of securitizing an issue. So we have what, in this case, they refer specifically as asset-based securities. Credit cards, auto loans, school loans, right? Obviously, these are all things that are issued, right? Sometimes they're issued by corporations, right? The corporations that have this kind of debt. They offer relatively high returns, interest and principal paid monthly, and they typically have fairly high credit quality, right? They're fairly low in risk. So they will have relatively high prices, right? The values will be high. But in the end, this is just another way of creating funds by these corporations so that they can issue more debt, if you will, to the public. We have what are referred to as some other specialty issues. I'm sure you may have heard the phrase junk bonds. These are just highly speculative securities that, for a multitude of reasons, are in a very risky position. They can be in a risky position because they are in trouble, right? They are potentially might go bankrupt. So these are companies that have financial distress. They're really running into trouble. But other companies can also be referred to as issuing junk bonds. They are very good companies. However, they just have a very large amount of debt. So this is basically, we're talking about a companies that some companies are good companies but are risky because of debt, and some of the companies are bad companies and are risky because they're bad companies. So these are junk bonds. They have relatively high yields because they are much riskier. So the prices of these are going to tend to be a little bit lower because they have higher risk. We also have debt that we can talk about that comes from international bonds. And these can be from a variety of applications, if you will. I like to think of these as being putting the United States in the center of the world. So foreign bonds are going to be bonds that are issued by foreign entities in foreign currency. So a euro bond is typically a bond that's issued by a foreign entity, but they're typically issued in United States dollars. So samurai bonds are typically bonds that are issued in Japan, but they're issued in dollars. Bulldog bonds could be debt that's issued in Great Britain, but in dollars rather than pound sterling. So again, debt is debt. It all acts the same, except now we have to add to this component, we have to add the additional level of risk that comes from currency exchanges, from political risks, international economic changes. All of those additional types of risk now apply to our international bonds. Just a conclusion here before we finish up. I just want to kind of reflect back on those things that we talked about called a TIP. A TIP is a United States Treasury bond that is indexed or changes or adjusts based on inflation. So here we have a debt. The par value is $1,000. And in the first year, let's say inflation was 2%. So what happens is the par value changes by inflation. So it goes from $1,000 to $1,020. So what that means is that the coupon payment is always based on par value. So again, if this is a 4% coupon bond, typically it would always pay $40 a year, but this year it's going to pay $40.80 because inflation is going to increase the par value, so it increases the coupon payment. If interest goes up the next year, again, inflation's 3%, it's 3%, 120 plus 3% is 1,050, and again, the coupon goes up again. What happens if inflation is 1%? Again, the par value is always adjusted by the annual inflation. So the coupon payment, if this was a 3-year bond, you'd get $42.44. You would also get this principal value. So the payments you receive would be adjusted for inflation over time. Now let's think about this bond in particular. If government bonds are default free, there's no chance that they're going to default. And if you buy a government bond that also has protection against inflation risk, this is a less risky bond than a regular typical government bond. So since it is less risky bonds are going to have even higher prices. Since they're going to be sold at higher prices, they're also going to have lower returns than government bonds. So if you think about the scheme of things, right? A government bond has a very low yield because it's default free. Treasury, these TIPS, have an even lower yield than that. Above a government bond, the United States Treasury bonds would be agency debt. Above agency debt might be municipal debt. Above municipal debt might be corporate debt. With corporate debt, the security bonds, mortgage bonds, etc., would be less risky than debentures or unsecured debt. So all of those things going from the least risky to the most risky, not even taking into account the ratings of those companies, we would go from very low risk to very high risk. That means we would be going from relatively high prices to relatively low prices. So again, that's just a picture, if you will, of the bond market itself.